The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3 o'clock. If you miss my show, you can always catch me on YouTube on my website, or you can catch me on Apple or Spotify, themainstreetcode.com. But I'm here every Friday, and I'm here for you to ask questions, to answer questions that you might have regarding any of your financial planning, whether it be life insurance, annuities, disability, long-term care. We are experts in those areas. We help hundreds of advisors across the United States, whether they be insurance experts, financial advisors, attorneys, accountants. They come to us for the advice, and we also are nonpartisan. We represent 30 different insurance companies, and we are solution providers. We're not trying to sell you anything. We are solution providers. So you need to look at your policies, review them, and understand what you have. And if we can do something better for you, that's how we get paid. And if we can't, at least we're going to advise you in what direction to go. So today, I want to talk about a couple things that are going on in my industry that you should be aware of. In many programs, we've talked about the need to purchase some sort of long-term care insurance. Long-term care insurance has been around, I guess, about 30 or 40 years. There was a big need in the market for people, other than their health insurance, to have some kind of financial bucket to take care of their, what we call activities of daily living. Feeding yourself, getting places, transporting yourself, taking a shower, taking a bath. These are very, what they call activities of daily living that over time, as we're living longer, we need help in this area. Or if we have develop cognitive issues. We know a lot of people, it's tremendous the amount of cognitive issues that have come up and continue to come up, as well as cancers and other things, but it's really both the mental and physical things as we age that we're going to need help with. And with that, they came out with something called long-term care insurance that would give you that peace of mind and that bucket of money if you should need that care later on in life. And statistically, and I say this a lot, the long-term care companies thought when they came out with these policies 30 years ago that they made a whole bunch of assumptions. And when an insurance company prices a product, or they come out with a product or an industry, they hire something called actuaries. And if those of you who don't know what an actuary are, I like to think of an actuary as a professional who uses mathematical, statistical, and financial techniques to assess the risk associated with an event happening, and they're hired to manage these financial risks when they do pricing of a product. Or they're sort of like a bookkeeper. They're looking at the odds of you needing long-term care. They're looking at the odds of you dying. They're looking at the odds of if you're buying house insurance of you having a flood or a hurricane. What's our potential liability here? So the actuaries for long-term care insurance missed the boat entirely. Market-wide, they missed the boat. Because when this product came out, a couple things happened. One is, as many insurance policies, they thought that people would drop this coverage. People were buying it in their 40s and 50s and 60s and weren't really using it till their 70s or 80s. And they figured by that time they would get tired of paying for their coverage. Well, people didn't drop their coverage at all. So statistically, they were on the hook for all these policies that they didn't think they would be on the hook for. That was part one. Part two of where they missed the boat. At the time, 30, 40 years ago, you would have a heart attack and the next day you'd be dead. Today, you have a heart attack, you're in and out of the hospital in one day, and if you have some of the HMOs in New York, they might even do it in your car. And one hospital day, and you're kept alive. And you may be kept alive for another 30, 40 years. But they may leave behind an impairment where you can't feed yourself, or you have a stroke and you can't do activities of daily living. So there's a claim. Now, claims used to last, statistically, when they did this, they figured you'd be at home for a year, 2 years, and then the average nursing home stay at the time was 2.5 years. Now, if it comes to the point where you need a home, a nursing home, or assisted living, the prices today have grown exponentially to $500 a day. I mean, like ridiculous amounts of money. And if you don't have this coverage, this valuable coverage, you're going to have to pay out of the pocket, or your children are going to have to pay out of the pocket, or as an adult child, you may have to pay for a parent until you run out of money. And the average stay is far longer. And I like to say the average stay today is until you run out of money. And somehow, when you run out of money or the government runs out of money, then all of a sudden you're not staying there anymore, you've passed. And that's not really a good solution. So these valuable policies are very important. Now, what New York State has done over time is these insurance companies, one of them went out of business that did long-term care. They're still paying their claims. They were probably the best claims payer out of all the insurance companies. And they kind of went belly up. And New York State Insurance Department has actually created a reserve fund to help them out. But they've never missed a claim payment. And to their own detriment, they took on higher risks than other insurance companies. They took on people with medical impairments. And they've kind of paid the price long term. And then we have other companies who wanted to have price increases, one in particular, which was the largest at one time, which was Genworth, at the most policies out of all the carriers. And what they would do is they would come out with a new policy every 2 years. Why? Because they wanted to keep the prices low, and they kind of locked in that price strategy, thinking that they could handle this tsunami of long-term care usage. And by the way, today, if you reach the age of 65, over 70% of us will need some sort of care. Over 70%. That's a huge, huge percentage. That's more than 2 out of 3 of us. Okay? More than 2 out of 3. When long-term care came out, they were calculating on 1 out of 2. 1 out of 2. Because you'd probably die before you ever use the policy. But that didn't happen. The policies didn't lapse and people didn't die. Now we're living longer, and with cognitive impairments, we're living 14, 15, 16 years with Alzheimer's. So the strain on the insurance companies has been humongous. They underpriced it, and now New York has done a wonderful thing, and they've capped the price increases from around the country. But all of a sudden now, Genworth announced that they were able to get through the state of New York 30% price increases per year on some policies, up to 270% in the state of New York. Now, if you did the right thing and you bought this policy in your 40s and 50s, and you are going to start seeing price increases, and you see these price increases, give us a call, because there's things we can do. There are going to be major price increases if you haven't gotten them already and you've done the right thing and purchased one of these policies. So what I do is I encourage you, give us a call, 631-647-4694, themainstreetcode.com. Call me, Neil Himmelstein, and I'm going to give you strategies if you're facing that, or your parents are facing these price increases. Give us a call, because there are certain things inside these policies we can do to help some cost containment. So, and there are strategies to cover the cost of long-term care with other methods. You're listening to the Main Street Code for Financial Planning, and we're going to be right back in a few minutes. Good afternoon. Welcome to the Main Street Code for Financial Planning. I'm Neil Himmelstein. I can be reached at 631-647-4694. And before the break, we were talking about major price increases are now happening for older long-term care policies. Particularly Genworth came out with a major announcement last week. Now, anytime an insurance company raises their price, they have to get an approval from the state of New York. New York has held back for so many years. Yes, they've had some price increases, but not as badly as they've had across the country. Now, all of a sudden, the floodgates have opened, and you're going to start seeing big price increases because the companies can't afford to continue because they underprice this market. So what do you do when you get one of those notices and you have a long-term care policy, or your parents have one? Maybe they're on a fixed budget and this and that, and all of a sudden this is a price we can't afford. The last thing you want to do is drop that policy, because now that you're 70, you're 80, now is when you're probably, the likelihood of you needing that policy and using that policy is getting closer in time. It's more valuable to you now than ever, because you've paid into it all those years. You don't want to just lose the coverage. So many of the policies that were done at that time had a lot of what we call riders, or riders are like bells and whistles that you could buy. Some of them are fantastic. As a matter of fact, I helped out a client about 20 some years ago when my kids were younger, and I recently got a call from him thanking me. He had actually it was a Genworth policy for him and his spouse. His spouse had gotten breast cancer, used the policy, and one of the things we had in that policy was a joint waiver of premium. So what does that mean? She passed away, they got to use the policy, and with their joint waiver of premium, he never has to pay a dime into this long-term care policy again, because she went on claim and used it and passed away, and he has a policy for the rest of his life that he doesn't have to put in his pocket and lay out a penny for. He said, "Thank you, Neil. I didn't even remember I put that clause in, but we did." And he's so thankful, and he never has to worry about a price increase, and he's doing extremely well. And he says, "I have the best long-term care policy that anybody on earth has." And he said, "Thank you." And I appreciate that. So that's one thing. So one of the things that we run into is people, how do I get a claim? How do I file a claim? I'm going to bring some people on to talk about that. But a lot of people are declined claims. Sometimes you need other professionals to help you look at that policy and get that claim. And that's very important. The second thing that you want to look at is many of these policies, and in particular, the New York State Partnership, required you to buy a compound interest benefit on the policies. So if you did the right thing and you bought policies when you're in your 40s and 50s and 60s, and you had a compound interest of 5% a year, your benefit pool went up. So while you may have started at $200 a day when you bought the coverage and you bought this compound interest thing, we've been getting calls where people have $500 and $600 a day of coverage and their price hasn't gone up, yet we can turn that trigger off or revise it so it doesn't grow quite as much because we're now have never used it and we've got this big bucket of money sitting there, and the pricing, having that rider was already maybe 50%, 75%, or 100% more if I didn't have that rider. But all of a sudden, if we turn that rider off, we can abate a big price increase. So that's something we look at. Some of them have what they call non-forfeiture clauses. They have certain clauses where you could actually have bought up a certain amount of insurance and not pay anymore. So that has to be looked at. So every policy has to be looked at. Some of the new policies that are standalone policies are capped at a certain amount, but some of the hybrid policies now with life with long-term care may be a solution for you to complement your long-term care and to cut it back and then have another bucket of money through what we call a hybrid policy, which has a life insurance component and a long-term care component. So if you need the long-term care, there's a bucket of money there. If you don't need the care and you pass away with it, there's a death benefit for your family and a legacy there. So it's an added protection to buy one of these hybrid policies, which they didn't have 30 years ago. So that may be a solution for you. Everybody has their own solution. There's not one person that's the same as everybody else. Not one. Your health is different 20 years later. Your finances are different. Everything changes. Everything evolves. So every case, every situation that a client has, we can address and figure out the best strategy. And if you're 40 or 50 and you have parents and they don't have coverage, okay, this is something you need to talk to them about. This is something you're going to drain the financial family fortune as well as deplete you emotionally and financially. It's almost a given. 70% of the people are going to need some kind of coverage or bucket of money to use. The other 30% end up taking care of the 70%. So 100% of us are going to need it. So if you're in your 40s and your 50s and your parents don't have a plan, talk to us. If you don't have a plan yourself, now's the time to make the plan when you're young and healthy, not after the fire starts. And believe me, there were articles this week in the newspaper, national articles. I heard it on TV, Newsday, front page cover. People younger than the age of 50, there's more cancers now under the age of 50 than ever. More cancers. Now, why is that? The environment, the food, whatever it is. But if you get cancer when you're younger, it's much more dangerous than when you get cancer when you're older. And you say, how do you know that? Well, we do underwriting for life insurance and long-term care. When you get cancer when you're younger, cancer is cells reproducing. They reproduce much faster when you're younger. So what happens if you're a cancer person, if you've gotten cancer and you're younger, the likelihood of it coming back is that much quicker, and the growth of that cancer happens that much quicker. So if you're in your 50s and you get cancer and you don't take care of it, or the likelihood of you surviving it is actually much lower than if you're in your 70s or 80s, because it moves that much faster along. So these are all considerations, and when we talk about planning and long-term care, it's so important that you make a plan. And it could be a legal plan. It could be something where we can't cover it with insurance. It could be tweaking your existing plan. It could be buying a hybrid plan. It could be maybe you have insurance policies that you're paying for term that are never going to pay out, and you reallocate that money towards something that's going to give you long-term care and life insurance. There's many ways to strategically plan out, but having no plan puts you in a dilemma, puts you in a huge hole when something happens. And I'm going to tell you, the likelihood of something happening increases every year. Why? They have figured out a way to keep us going longer and longer and longer. In what capacity is the question. Now, we talk about COVID as well. The effects of long-term COVID, they still don't have all the effects of long-term COVID. What my doctor is telling me in the research he's done, now this is from him, not from me, is that a lot of long-term COVID is going into dementia, that it's affecting our minds. I don't know that to be true or not. I'm not a doctor. I don't have the statistics. But you better believe the insurance companies and actuaries are looking at this as another risk factor that you and I haven't considered. And we know the actuaries screwed up many years ago. They're trying to get it right now. We know we have price increases. This is what happens in an industry that's unchecked. But this is why you need to check your own personal plans and your own personal policies and give us a call. You're listening to the Main Street Code for Financial Success. Again, 631-647-4694. Have a fantastic weekend and enjoy the rest of your summer. Have a great day, everybody.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.